To a student of the stock market, the price chart offers a clear record of history. It tells the story of where a stock has been, detailing its advances, its declines, and its periods of rest. But price alone tells only half the story. It shows what happened, but it does not fully explain the force or the intent behind the movement. For that, the analyst must turn to the second dimension of market action, volume. Richard Wyckoff considered the study of volume to be an indispensable part of his methodology. He understood that volume is the fuel that drives all significant price moves. It is the direct measure of the energy, the intensity, and the conviction behind the actions of buyers and sellers. To ignore volume is to read a book by looking only at the pictures, missing the rich and revealing narrative contained in the text. Wyckoff saw the relationship between price and volume not as a mere correlation, but as a window into the mind of the Composite Man, the great operator who represents the sum of all smart money. Volume reveals his hand. It shows when he is active and when he is idle. It signals his intentions, his confidence, and his power. This video will serve as a comprehensive guide to reading the market through the lens of volume, just as Wyckoff did. We will explore in 3 parts how this single element can be used to predict future price moves with a remarkable degree of accuracy. We will move from the fundamental laws that govern its interpretation to the specific practical signatures that signal the accumulation of strength and the distribution of weakness. This is the science of reading the force behind the price. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The entire science of Wyckoff's volume analysis is built upon the foundation of his third fundamental law, the law of effort versus result. This law states that for every action in the market, there is a reaction, and the nature of that reaction can tell you a great deal about the underlying balance of power. In this context, the effort is represented by the volume of trading. The result is the price movement that is or is not achieved by that volume. The relationship between these two elements, whether they are in harmony or in discord, provides some of the most reliable clues to the market's future intentions. First, let us consider the principle of harmony. Harmony between effort and result exists when the volume is consistent with the price movement. If a stock is in an uptrend and it advances on expanding volume, the effort is in harmony with the result. The increasing volume confirms the strength of the buying demand and suggests that the trend is likely to continue. Similarly, if a stock breaks out of a long trading range on a sudden and massive expansion of volume, the great effort justifies the significant result of the breakout, and it signals the beginning of a powerful markup phase. This harmony is the signature of a healthy, sustainable trend. The more critical and often more profitable signals, however, come from the principle of disharmony. Disharmony occurs when the effort and the result are out of sync. This divergence is a powerful warning sign that the current trend may be in danger of reversing. One of the most common forms of disharmony is high volume with little or no price progress. Imagine a stock in a strong uptrend. Suddenly, the tape shows an enormous volume of trading for a single day, but at the end of that day the price has closed only fractionally higher, or perhaps even lower, than the previous day. The effort was immense, but the result was negligible. This is a major red flag. It indicates that the strong buying demand is being met by an equally strong, or even stronger, wave of selling supply. This is the classic sign of distribution, where the Composite Man is feeding his large line of stock into the eager hands of the excited public at the top of the market. The public sees the high volume as a sign of excitement and strength, but the Wyckoff analyst sees it as a sign of a titanic struggle where the buyers are no longer winning. The same principle applies at a market bottom. If a stock has been declining and then enters a trading range, a day of extremely high volume with little further downward price movement is often a sign of a selling climax. The great effort of the sellers is no longer producing the result of a lower price. This indicates that a powerful buying force, the Composite Man, is absorbing the selling pressure, a clear sign of accumulation. Another form of disharmony is a significant price move on low volume. If a stock breaks out above a resistance level, but does so on conspicuously light volume, it is a sign of weakness. The result, a new high price, was achieved without any significant effort or buying power. This indicates a lack of genuine demand from informed interests. Such a move is often a manipulative upthrust, designed to trap unwary bulls, and it is very likely to fail. The law of effort versus result provides a constant logical framework for interpreting volume. By always asking, was the effort justified by the result? The analyst can begin to see beyond the price and understand the true balance of power that is shaping the market. At its core, volume is the measure of supply and demand. High volume, in any context, signifies a high level of interest and urgency. It proves that there is a significant disagreement about the value of a stock, and that both buyers and sellers are acting with conviction. Most importantly, consistently high volume is a sign that large operators are active. The Composite Man cannot accumulate or distribute a large line of stock without trading in enormous quantities. Therefore, a surge in volume is a signal to the analyst to pay close attention, as it indicates that the professional money is at work. Low volume or dullness signifies the opposite. It shows a lack of interest and a withdrawal of the professional element. When a stock trades on very light volume, it means that the Composite Man is either idle, or he is deliberately allowing the stock to drift in order to discourage public interest. The interpretation of low volume depends entirely on the context. In an accumulation range, a period of extreme dullness after a reaction is a very bullish sign. It suggests that the selling pressure has been completely exhausted. The supply has dried up. Conversely, at the top of a long advance, a rally on fading light volume is a sign of weakness. It shows that the buying power has been exhausted. The demand is drying up. Wyckoff often used the analogy of gasoline to explain the function of volume. He compared the volume of trading to the amount of gasoline being fed to an automobile's engine. A sudden, brief surge in volume after a period of dullness is like a quick tap on the accelerator. It may cause a brief spurt of speed, but it does not provide the momentum for a long journey. This type of volume spike is often climactic and signals the end of a short-term move. On the other hand, a gradual and sustained increase in volume over many days or weeks is like steadily pressing down on the accelerator. It builds momentum. It shows that public participation is growing and that the move is gaining power. A trend that is supported by this kind of gradually expanding volume is far more likely to be sustained than one that is driven by a single, isolated burst of activity. It is also crucial to consider volume in relative, not absolute terms. A volume of 50,000 shares may be highly significant in a stock that typically trades only 5,000 shares a day. The same 50,000 shares would be meaningless in a major market leader that regularly trades millions of shares. The Wyckoff analyst is always looking for a change from the norm. It is the sudden increase from dullness to activity, or the sudden shrinkage from activity to dullness, that is most significant. This change is what alerts him to a potential shift in the balance of supply and demand, and prompts him to look for further evidence of a new market move. To fully grasp the intentions of the Composite Man, Wyckoff did not just look at the total volume for the day. He analyzed the character of the volume as it was printed, moment by moment, on the stock ticker tape. This is the art of tape reading, and it involves distinguishing between the actions of large operators and the actions of the public. He understood that the size of the individual trades printed on the tape was a powerful clue to the identity of the player. Large lots, trades of 1,000, 5,000, or even 10,000 shares, are almost always the work of the Composite Man. The average trader simply does not have the capital to trade in such sizes. Therefore, the appearance of these large blocks on the tape provides a direct window into the actions of smart money. If these large lots are being taken at the offered price during a rally, it shows aggressive, powerful demand. If, however, they are being sold at the bid price during a decline, it shows aggressive supply. At a market top, the appearance of many large blocks trading within a very narrow price range, with the price making no upward progress, is a classic sign of distribution. Small lots, trades of 100 or 200 shares, are typically representative of the actions of the public and smaller floor traders. While a single small trade is insignificant, the collective action of thousands of these traders creates the broad market into which the Composite Man operates. Wyckoff viewed the small lots as the feathers on an arrow. They indicate that the business end, the powerful force, is represented by the large lots. By observing the interplay between these two types of volume, the analyst can form a clear picture of the market's inner workings. For instance, imagine a stock is declining. If the tape shows a few large blocks being sold, followed by a torrent of small lots selling as the public panics, and then at a lower level the tape begins to show large blocks being bought, absorbing the small lot selling, the analyst is witnessing accumulation in real time. The Composite Man is using the public's fear to acquire his shares. Conversely, if a stock is rallying and the tape shows large blocks being consistently offered for sale, capping the advance every time the price tries to move higher, while the buying is predominantly in small lots from an excited public, the analyst is witnessing distribution. The Composite Man is using the public's greed to unload his shares. This moment-to-moment analysis of the volume's character, distinguishing between the actions of the informed professional and the uninformed public, was the foundation of Wyckoff's tape-reading skill. It provided him with an immediate, real-time understanding of the balance of supply and demand, long before the picture became clear on a daily or weekly chart. Having established the foundational principles of volume analysis and the supreme importance of the law of effort versus result, We now turn to the practical application of these concepts. The primary objective of a Wyckoff analyst is to align his interests with those of the Composite Man. This means buying when the Composite Man is buying and selling when he is selling. The entire process of a bullish market campaign, from its secret inception to its public triumph, is written in the language of volume. By learning to read the specific volume signatures that appear at each key stage of the accumulation and markup phases, the analyst can identify, with a high degree of confidence, the stocks that are being prepared for a significant advance. This section will serve as a detailed guide to these signatures of strength. We will dissect the bullish side of the market cycle piece by piece to reveal how volume confirms the presence of demand and predicts a future uptrend. The first and most dramatic volume signature of strength often appears at the very bottom of a major decline. This is the selling climax. As a downtrend accelerates and public fear turns to panic, a final convulsive wave of selling enters the market. On a chart, this is marked by a day of exceptionally wide price spread and, most critically, by a climactic surge in volume. To the untrained eye, this massive volume on a day of sharp decline looks terrifyingly bearish. It appears to be a confirmation of the selling pressure. But the Wyckoff analyst understands the true meaning of this event. He knows that for every share sold, there must be a buyer. The immense volume of a selling climax is therefore not just a sign of intense selling. It is a sign of equally intense buying. It represents a massive transfer of shares from the weakest, most fearful hands into the strongest, most patient and well-informed hands. The Composite Man uses the public's panic as his opportunity to absorb a huge quantity of stock at bargain prices. The very high volume is the effort. The result is that the price stops going down. Often the price will close well off its lows for the day, demonstrating that the buying power was so immense it was able to overwhelm the selling pressure within that single session. Wyckoff's analysis of the market bottom in December of 1930 provides a textbook example. After a sharp decline, the market experienced a day where the price range widened dramatically and the volume surged to over 5 million shares, a huge figure for the time. A large part of this volume occurred as the market made its extreme low and then rallied away from it. This was the irrefutable evidence that the force of supply had been met and conquered by a superior force of demand. This climactic volume action is the first and most powerful sign that a downtrend has likely ended, and that the process of accumulation has begun. Following the selling climax and the subsequent automatic rally, a stock enters its accumulation trading range. It is within this long sideways consolidation that the most subtle but important volume analysis takes place. The key confirmation that must follow a selling climax is the secondary test. When the price drifts back down to test the low of the climax, the volume signature is critical. A successful secondary test must occur on a volume that is a mere fraction of what was seen during the climax itself. This dramatic shrinkage of volume is the proof that the selling pressure has been exhausted. It confirms that the panic is over, and that there is little or no stock being pressed for sale at these low levels. Throughout the entire trading range, this same principle applies. The most important bullish volume signature during accumulation is the gradual drying up of supply on reactions. On each swing down toward the support of the range, the volume should tend to become progressively lighter. Wyckoff emphasized that dullness after a decline is a sign of strength, as it indicates a lack of selling pressure. The Composite Man may deliberately withdraw his bids at times, allowing the stock to drift and turn dull. This serves to tire out impatient holders and further discourage public interest. When he sees that these dips fail to bring out any significant volume of selling, he receives his confirmation that the floating supply is being successfully absorbed. The other side of this coin is the character of the volume on rallies within the range. While volume should shrink on reactions, it should tend to expand on the rallies from the support level up toward the resistance. This shows that demand is present and is actively working to absorb the remaining overhead supply. This interplay, expanding volume on rallies and contracting volume on reactions, is the heartbeat of a healthy accumulation. It is the chart's way of telling the analyst that demand is quietly but persistently gaining control. As the accumulation campaign nears its end, the Composite Man often employs a final manipulative test of the supply, the spring or shakeout. The volume signature on this maneuver is of the utmost importance. As we have discussed, a spring is a sharp thrust below the support of the trading range designed to mislead the public. Wyckoff identified two types of springs, each defined by its volume. The first and most powerfully bullish is the spring on low volume. This occurs when the price breaks support, but the volume is conspicuously light. This is a definitive sign that the sellers are gone. The Composite Man has pushed the price